Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And when it comes to making life's biggest purchases, there's really no such thing as paying cash anymore. With the cost of living being as high as it is, you're not going to be able to pay for school outright. You're not going to be able to pay cash for that good used car. And don't even get me started on trying to purchase a home. So when it comes to making those big purchases, most people are going to have to rely on some type of debt. The thing about debt is that if you don't understand how it operates and what all of the moving pieces are when it comes to that money that you're borrowing, you can dig yourself in a very deep hole that it seems impossible to get out of. In this video, we're going to get into what debt is and we're going to get into those inner workings. And then at the very end, we're going to go over the easiest and most effective way that you can go about paying it off, the Snowball method. Stay tuned. So what is debt? Well, according to Webster, debt is an obligation to someone, meaning you owe something. In the world of finance, it's a financial obligation that you owe someone, most specifically a bank or some type of lending institution. Debt can be argued good or bad, and that argument can go on forever. But regardless of how you feel about the debt you have, it will always equal stress. To keep that stress at bay or to keep it at the most manageable level possible, you have to understand what debt is and how it operates. So debt's broken down into two different types. You have collateralized debt and non-collateralized debt. Collateralized debt is going to be debt that you owe on a piece of property that you own. And the reason that it's considered collateralized is because the bank can come in, repossess the property that they lent you money for, and then sell it to recoup some of the money that you weren't able to pay. Because the bank has the authority to go in and take that piece of property, this is going to keep the interest rates lower on collateralized debt. The exact opposite is true when it comes to uncollateralized debt. Uncollateralized debt is going to be your credit cards or the things that there's no property backing the debt that you have. Because of that additional risk that the lender is taking on, the interest rates on non-collateralized debt are going to be much higher. An interest rate is a way for banks to make money. It's also a way for banks to compensate themselves for the risk of lending you money. To you, an interest rate is the cost of borrowing that money. So the higher the interest rate is, the more it's going to cost you for that loan. Now, interest rates are typically broken down into two types. You have a fixed interest rate and a variable interest rate. Fixed interest rates mean it stays the same throughout the course of the loan. Variable interest rate means it changes over the course of the loan. Fixed interest rates you're typically going to find on a mortgage or on a car, something with collateral behind it. On debt that doesn't have any collateral, that's where you're going to find those variable rates. To give you an example of how interest rates affect the cost of borrowing money, we're going to compare mortgage rates from 2021 to today. In 2021, you could easily get a 30-year mortgage for 3.5%. In today's times, it's 7% or double. On a $300,000 house in 2021, the principal and interest payment alone would be $1,347 if you had a 3.5% rate. Today, that exact same loan is going to cost you $1,996 a month. And we're not even factoring in taxes and insurances. So the difference between these two is right at $650, and that's all due to the fact that the interest rate on a 30-year mortgage has doubled. Now, over the course of that 30-year time frame, the home you bought in 2021, you're going to pay just shy of $185,000 in interest. So your all-in cost for that home would be $485,000. Fast forward to 2024, the total amount of interest you're going to pay over the next 30 years is $418,500. You add that to the $300,000 you borrowed, and that $300,000 house that you purchased in 2024 cost you $718,500. This is what I mean by the higher the interest rate, the more expensive it is for you to borrow that money. And you need to keep this in mind as you compare your lending options. With debt, there are terms that you need to be aware of. When you get all of the documents to sign for a loan, there's so many terms that it's hard for anyone to really keep up with, and your lender probably can't explain them all to you. But there are some basic ones that you need to understand. The first of which is the easy one. It's the principal or the amount of money that you borrowed. So for a $300,000 house, you get a loan for $300,000. $300,000 is your principal. Pretty straightforward. The next one is a lien. What a lien represents is a legal right to a piece of property. So if a lending institution gives you money on a home or a vehicle, they're going to put a lien against that property. If you don't pay, then they can step in, repossess the property, and then sell it. So because they lent money on that property, they have a legal right to the ownership of that property if you don't pay. The next term I want you to know is equity. And equity is the value of your property minus the loan that's against it. Using that same $300,000 house, if you have a $250,000 loan still outstanding on that house, your equity is $50,000. The next term that I want you to understand is your debt to income ratio, and we covered this in our credit video last week. But the way that the debt to income ratio works is it compares your overall minimum debt payments to the total amount of gross income that you receive every single month. On your screen, you can see an example of how this works. If we had 4 loans outstanding, the minimum payments were $300, $150, $200, and $1,500, then your total monthly outlay on your debt is $2,150. If you bring in $6,000 a month, we're going to take that $2,150 and divide it by 6,000. What this is going to equate to is your debt to income ratio. And in this example, it's right around 36%. The next term that you should understand is loan to value ratio. And what this represents is the percentage of the value of your property that's taken up by debt. The easiest way to understand this is with an example. So if we take the same $300,000 home, it has a $250,000 loan on it. We divide the 250 by the 300, your loan to value ratio is 83.33%. If you're looking to purchase a home and you want to use a conventional loan to avoid PMI, then you're most likely going to have to put down a 20% down payment. The reason this is because it makes the loan to value ratio 80%. So for a $300,000 home, your loan at maximum can be $240,000 to satisfy that 80% loan to value requirement. So you get to the closing table, you have to write a check for $60,000 to keep that loan to value at 80%. So we understand what debt is, we understand the common terms that you're going to come across when it comes to borrowing money. The next thing we need to go over is how to get rid of it. And there are many ways that you can go about paying off your debt. There are so many methods that it's hard to keep up with. But the easiest one that I have found that works for the most people is the Snowball method. And this was popularized by Dave Ramsey. Dave and I don't always see eye to eye on a lot of things. But with this method specifically, I can get behind it. The way the Snowball method works, you take all of your debt and you sort it by balance, from smallest to largest. Any additional money that you have every month to put towards paying off your debt, you add it to the minimum payment of the smallest balance debt that you have. Once that debt's paid off, you take all of the money that was going towards paying debt number 1 off and roll it to debt number 2. And you continue on with this process until all of your debt disappears. So to give you an example of how this actually works, let's say you had 4 debts outstanding. You had one credit card with $2,500 on it. You had another credit card with $5,000 on it. You had a student loan of $15,000 and a car loan of $25,000. The minimum payments on those loans is $100 for credit card number 1, $150 for credit card number 2, $250 on your student loan, and $500 on your auto loan. If we assume that you had an additional $50 a month that you could put towards paying down your debt, we're going to add it to the $2,500 credit card. Your new payment each month is going to be $150. This is going to get you to pay off much sooner than just paying that $100 minimum. Now, once debt number 1 is paid off, we're going to take that entire $150 and add it to the minimum payment of debt number 2. So on that second credit card, your new monthly payment is $300. Once that's paid off, we take that $300, we add it to the $250 of debt number 3, $550 a month. That student loan is going to be gone fairly quickly. Once the student loan's paid off, we take that $550 a month that you were putting towards it, you add it to the $500 payment on your car. You're now putting $1,050 per month towards paying off your vehicle. Once that vehicle's paid off, which it shouldn't take much longer, then you're going to have an additional $1,050 per month to do with whatever you want. Now, me being the finance guy and being all about the money, I would want you to save it, but that's just not practical. What I want you to do is I want you to take 20% of that additional cash flow that you have, and I want you to add it to your want spending. Blow it. Enjoy it. You've spent however long paying off all of that debt. Take some time and enjoy it. Use some of that new cash flow that you have and go do something with it. Go out with your friends, save up for a few months and take a trip. Don't put it back on a credit card, but take 20% of your new free cash flow and go and enjoy it. The other 80%, put that money to use. Put it into your savings, fund your emergency fund more, put it into a Roth, add more money to your 401k, whatever you want to do. 80% of your new free cash flow, use it towards your financial future. The other 20%, blow it. Use it however you want. Now, some of you may be wondering, well, what about the avalanche method? Well, the issue with the avalanche method is it may take a little bit longer to get that first loan paid off. And if you're not familiar with the avalanche method, the way that it works is that as opposed to sorting your debt by balance from smallest to largest, you sort it by interest rate from largest to smallest. And then you focus all of your debt repayment efforts on that highest interest rate loan. And then once that's paid off, you take all the money you were putting towards that loan and move it down to the next highest interest rate. With the snowball method and sorting it by balance, there's a higher probability that you're going to pay off that debt quicker than if you were to choose your highest interest rate debt. Because we are a species that thrives on instant gratification, the snowball method is going to put you in a position to start achieving your goals a little bit sooner. No, you may not save as much interest as you could on the avalanche method, but the chances of you sticking with your debt repayment plan are a little bit higher. And this was actually proven by a study that was done by the Harvard Business Review, and I'll put a link to that in the description of the video. But I'm a huge proponent of the snowball method. I think it works, and I think it works better for most people than the avalanche method. One of the unfortunate parts about our society is that we're under constant pressure to be a consumer. With social media, we can keep up with what everyone around us is doing. The new clothes that someone has, the new car that someone has, the new house that someone just purchased. We can see all of those things, and we feel pressured to keep up. It's natural. It happens. The problem with trying to keep up is that once you begin spending outside of your economic ability, you're going to take on debt. And keep in mind that the pictures that people post behind all of those pictures is probably a lot of financial stress. So don't worry about trying to keep up with people, because if you do, then you're most likely going to take on debt that you don't need. Debt is stress. It will always be stress, regardless of what you use it for. Debt is going to be stress because it's always going to be hanging over you. But if you understand how debt works, if you understand how interest rate works, and you have a good plan to pay off the debt you do have, then you're going to put yourself in a position to have a very bright financial future. I want to thank you so much for tuning in. If this video or any of the other videos that I have put out has provided you value, then hit that subscribe button. If you know someone that's struggling with debt and they just don't know what to do to get out of it, then send this video to them. Maybe it'll help get them going in the right direction. But I want to thank you so much for tuning in. I'll talk to you soon.